The tariffs have a price effect, but I would guess these tariffs and the uncertainty with them on margin lower growth. So you got a bunch of cross currents, and I would guess the net of it all is, I would guess, yeah, growth is probably slowing a little bit right now, and the uncertainty, as well as when you cut government spending and you reduce workforce growth, or you reduce the growth of it, you know, you limit GDP growth. The effort is, I don't know if that's that concerning, and that I think the effort of this administration is to try to create more organic, more private sector growth, less government-led growth, so quote unquote healthier growth. But top line growth probably is going to be somewhat weaker, I would guess.
So, Robert, given that backdrop and the five big structural changes that you just outlined, if I'm the Federal Reserve, do I just sit on the sidelines and kind of let it all play out? Because the market is kind of suggesting that the Fed's not going to do a lot this year.
Yeah. Yeah, I think the right thing, yeah, the Fed is quietly drifting stage left, and that's okay. The center stage is structural changes, executive branch changes away from the Fed. And in a period like this, I think the wisest thing the Fed could do, yes, is be comfortable standing pat, be careful about what they say, because I think commenting too definitively on how these structural changes are going to play out, it's too early to do it. Tariffs is a good example. We don't even know what the tariffs are going to be. And so, yeah, I think the Fed will do less. I think that's fine. And I think Jay Powell's communication on that has been good recently, where he's made clear we're in no hurry, and people should be prepared. Their focus should be more on what's going on at the executive branch. And the second comment I'd make, if there's a rate I'm focused on, I'm much more focused on the 10-year Treasury rate than I am the Fed funds rate.
Interesting. So, Robert, as we sit back here and we think about the economic backdrop here, how do you view the consumer right here? I mean, we've heard about and talked about and noticed in the data this K-shaped economy. How do you think about the consumer?
There's two big groups. It's confusing because there's two big groups, probably unlike maybe anything I've seen in my career. There's one group that's 65, let's rough numbers, 65, 70 million workers that make 55 grand a year or less. And they are struggling to make ends meet. They've lost at least 25% purchasing power. They don't tend to own financial assets. That group is spending, but they're watching every dollar. They're going to McDonald's and they're agonizing over even McDonald's trading down. That's 65, 70 million workers and consumers.
Right.
There's another 65 to 70 million consumers, 55 and older, own their home, have a fixed rate mortgage, have financial assets. And this recent period has been pretty good. Yes, there's inflation, but their financial appreciation, their financial assets has offset it. And because their mortgage is fixed, they're really not that sensitive to higher rates. And they are spending much more aggressively on services and other products. And that's why when you see corporate earnings reports, it's confusing. Which of these two groups are you serving? If you're serving that first group, you're likely seeing a much more challenging business. If you're serving the second group, you know, business looks better to you.